Hey guys, it's Sasha. US inflation data for June just came in this morning, and on the one hand, the data is phenomenal. Prices in June fell by 0.1%, which means the year-on-year inflation is now down to 3.0%, but there is a big problem. The big problem is that while this is looking great right now, it could be an indicator that the Fed is now pushing the economy into deflation. And if the Fed doesn't start doing their job, if we actually go into a deflation spike, that will be a heck of a lot worse than the inflation problem that we had 2 years ago. This could be a situation where the medicine that is curing inflation has side effects that are much worse than the symptoms of the inflation disease. So let's dive into the numbers so that I can explain what's happening in this risk a little bit better. Today's inflation data is 3% or 2.98% if you work it out more accurately, and this is the lowest read since the inflation spike started in 2021. This is the first time that it's fallen below 3%. In the last month, prices have gone down 0.1% after staying flat in May. So inflation right now, over the last 2 months, is at 0 or slightly negative. And what was the key driver for this drop? Well, it's not so easy to see, but it's actually shelter right down here. Shelter went up 0.2% in the last month, which is very low. You can see it's been stubbornly sitting at around 0.4 to 0.7% for the last 3 years. To see how big of a drop that is, here is a chart of the month-on-month movements in shelter inflation. This big drop at the end is the data for June. And the reason this is important is because shelter makes up over 36% of total US inflation, by far the biggest factor, and shelter is now sitting at 5.2%. So shelter is right now still holding up the overall number. If you work it out, the rest of inflation, the rest of the index put together, everything else except for shelter is at 1.75%. So everything except shelter is at 1.75%, which is below the Fed's 2% target. And here's the thing, shelter is a lagging indicator. It's a combination of rent and mortgage costs. Rent prices have been sitting at 0% growth for the last year. It's ticked up slightly towards the 2% mark in the June data. In the official inflation data, rent of primary residence is still sitting at 5.1% because shelter data in the official inflation figures is a lagging indicator. It is so slow to catch up with reality. It is coming down, but it's coming down very slowly. From all the market data that we have on rent, we know that the number will continue coming down because we have already seen the data. It's already happened. We just have to wait for it to turn up in the inflation data. It will take some time, but the good side of that point is that it will continue going down. We already know that. And mortgage costs, they don't go into inflation data directly because they are not collected, but you can see that the owner's equivalent rent is sitting at 5.4%. And this is meant to be a proxy based on a valuation of how much you would have to pay in rent to live in the house that you actually own, with some caveats. Not a hugely important topic, but the reality is that interest rates do affect this number because landlords who actually rent properties out and mortgage owners pay interest. Now, most mortgages in the US are long-term fixes, so short-term fluctuations in interest rates are not a huge deal because all the people who don't move during that period, they don't get affected. People who took out their mortgage in the time before rates start going up do not see any change to their payments. However, you have two second-order effects that happen here. One, when rates go up, the propensity of new properties to enter the rental space goes down. Landlords are less likely to go and buy new rental properties when interest rates are sitting at 7 or 8% on mortgages because they can't compete on rental prices with people who have mortgages at 3%. It becomes a relatively difficult business to operate. So you have an artificial squeeze on availability which pushes prices up. So this exacerbates the problem because high interest rates do push prices up, even if not directly. But taking a step back, the important thing here is this. Remember, shelter is at 5.2% right now. Overall inflation is at 3.0%, but without shelter, the rest of it is at 1.75%. So as shelter continues slowly making its way down in the next few months, the overall number is going to continue moving down as well. And the big question is, how fast will this happen? Well, here is the month-on-month inflation read for the last 12 months. So when this data just came in, the June number fell out of the 12-month read. So 0.2% fell out, minus 0.1% came in to replace it, and the overall inflation number fell by 0.3%. Pretty simple. July is also at 0.2%, so that's going to fall out next month. But look at the data for August and September. Inflation went up 0.5% in August last year and 0.4% in September. So when we get inflation data for August and for September this year, because you're comparing year to year, what happens if that month-on-month data is at zero again like it has been for the last 2 months? Well, if it's zero for the next 2 months, then inflation will drop to 2.3% overall. And if it's zero again in September, just as an example, then the annual inflation read will be at 1.9% or thereabouts, below the Fed's target. Now, I'm not saying that this will happen. In fact, I don't think it is highly likely that inflation will sit at flat zero for a long period of time. But it has been at zero for 2 months now. It is not a hugely unrealistic assumption. The problem is that it might not stop there, because shelter is not going to be down to 2% or 0% in the next 2 months. Shelter will come down, but only slowly, only a bit, and shelter will continue falling after September. At the moment, oil price is still hovering relatively high. Brent crude is sitting at $85. So what happens if oil reverts back to a lower price in the longer term? What happens if it goes down to a stable price of $60 or $50 or even $40? Well, that'll be a huge downward factor on inflation. And then we risk having a massive problem, because when inflation is going to dip below 2%, it may well begin heading right towards the 0% mark. At the moment, the Fed still seems to not understand or appreciate or acknowledge this risk. Just yesterday, Jerome Powell was giving testimony before the House and said the Fed still needs to see more data before it acts. There is no chance that they're going to do interest rate drops anytime soon. They need to see more data that inflation is definitely heading towards 2%. The problem with the Fed is that it's a bunch of old farts who sit around pretending that they understand what they are doing. In reality, they clearly have no fucking idea what it is that they are meant to do. We've seen it over and over. This is why they were 2 years too late with increasing interest rates when inflation started going up. They started increasing rates when inflation was already almost 10%. They were busy sitting there scratching their asses and waiting to see more data. And it is also why the Fed is now way too late on reducing rates. Exactly the same problem, exactly the same reason in reverse. It's been extremely obvious where inflation data is going for the last year. I've been talking about it on my channel every single month. Go and check my videos. I've got the receipts. And I've been showing the data and explaining why inflation is heading where it's going, because it wasn't rocket science. And I've been doing that for over a year. So why is it that a random guy on YouTube can clearly see and analyze the data, and many other people can as well, and tell you exactly what's happening with inflation, but a bunch of overpaid guys in suits seemingly have no idea? Well, good question. I guess using a brain is not very popular these days. I've been getting a boatload of hate for sharing my opinion and analysis. I've had multiple other YouTubers, for whatever reason, make a song and dance about how I'm so wrong and how inflation is going to spike again. It's going to go off the charts. We haven't seen the worst yet. The top is going to come. Blah, 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 fucking blah. Some of these big YouTubers made whole videos debunking my inflation analysis. Hey, meet Kevin. Do you like apples? Well, how do you like them apples? Electricity is down 0.7% month to month, by the way. What a fucking clown. Anyway, why is deflation a big risk? Well, right now, the real inflation, if you ignore the lagging shelter indicator, is at 1.75% and falling. Energy prices are still artificially elevated. We're starting to see them come down right now, but they have a long way to go before they normalize compared to commodity price trends. So the likely path there is down too. Car insurance is still insanely high because there is an organized cartel jacking up prices while the authorities are doing absolutely nothing about it. But car insurance prices are up at 19.5%, which is insane, but it is falling. Last month, it was only on 0.8%, which is a 10% annual run rate. So even that marker is on the way down. So every single metric, every single trend, every reasonable long-term prognosis that you can look at is pointing to inflation coming down sharply over the next few months. But the Fed is still sitting around, scratching their balls, giving frickin' interviews and turning up to banker events saying that they need to wait for more data. The US interest rate right now is at 5.5%, while the real rate of inflation is at 1.75%. And this means that the interest rate is exerting a very significant and outsized downward pressure on prices in the real world, because you are a lot less likely to go and buy a new car when car finance is really expensive. It is a lot more expensive to buy something on your credit card because interest rates are high. We have price gouging on things that people have no choice in buying, that people have to spend money on. We have price gouging on energy, we have price gouging on insurance, things like that. But everything else is sitting at pretty much 0% inflation already because market forces are at play there. So what happens if the Fed continues doing nothing? Well, if shelter continues moving down and pushes below 4% in the second half of this year, if the rest of the trends continue as they are, inflation may well begin moving to zero in Q4. And if inflation moves below zero, we will enter a deflationary scenario, which could translate into a deflationary spike. Here is why deflation is really bad. When you have inflation, you run the risk of a price-wage spiral. So as prices go up, employees demand more money. When employees get more money, they can afford to spend more, and it costs the companies more money to produce the goods and services because they have to pay their employees more. So prices on those things have to go up, and then people want even more wage increases to cover those increased prices, and so on and so on. You get this vicious circle. If you're not careful, the situation can get out of control, as we've seen time and time again. Recently in Argentina and Turkey, they've both had inflation go absolutely whack. But there is a controller in that equation. The controller is the companies who get to decide whether or not to grant those wage increases. In many cases, employers are forced, they're pushed, there's a lot of pressure to increase wages because otherwise, their employees will leave and go somewhere else where they get paid more, blah, blah, that stuff. There is market pressure. But the companies don't have to increase wages, and if the companies find themselves in a difficult financial position, for example, recovering from an unprecedented economic crisis, as we've been seeing in the US economy after COVID, they are more likely to go and tell those employees that, they can go and do one, pay increases that are being wanted are not coming. Average weekly earnings in the US have now fallen to 3.6% in this latest report. So the US has avoided hitting that spiral. Now, when you have deflation, you have a different kind of problem. Deflation means that prices are going down. And so let's say you want to buy a car or a toaster or whatever it is that you want. If you don't have to buy it right now, if you're not extremely time pressured, if you can wait, say, a few months, then the price of that thing that you want to buy will be lower. So you might as well wait and not spend your money, right? This causes a very big suppression in demand. And if demand gets suppressed, prices have to go down. And this makes the problem worse. You get a different kind of vicious circle, right? Because people benefit even more from not spending their money because prices are going down faster. And it multiplies by itself. Their money is worth more if they just keep it in their pocket. So why would people spend? And the reason why economists say that deflation is a much more serious problem is that the controller in this equation is human behavior, not corporations trying to prevent paying their employees more money. And if people see that they benefit by delaying their spending, people will delay their spending because they get to save money. They get to buy more for the same money. And changing that behavioral spiral is a heck of a lot harder than with inflation. Because with inflation, you just jack up the interest rates and you stop the flow of money. Maybe revert the flow of money. But what do you do with deflation? Well, you kind of have to do the opposite treatment, right? But how do you do the opposite? You've just started to try and shrink back the money supply after the inflation spike that was caused by the money supply going up. So is the Fed going to go and do a U-turn and turn on the printers again in an emergency, trying to, stop the deflation from happening. And negative interest rates are theoretically possible. It'll mean that you will be paying interest to your bank to keep your savings for you. And in theory, that might mean that people will be pressured to take money out of their banks to spend. But at the same time, you might as well not spend because, you can wait and prices are going to go down. Now, I don't think I need to spell out the potential fucking crazy implications and ramifications of what that can do to the economy. If the negative interest rates were not negligible and the banks could not absorb them, we could be seeing some seriously big problems. So deflation is a much scarier prospect in theory because it is much more self-propelling than inflation, and it is much more difficult to cure. It's more difficult to stop. But having said that, there is a possibility that the Tweedledums of the Fed will wake up and smell the coffee. There is one more meeting at the end of July for the FOMC in just about 3 weeks, and at the moment the market thinks there is only an 8.8% chance that the interest rate will drop 25 basis points at that meeting. I am not counting on it, but who knows? It's possible. Maybe it's a lot more possible now. The next meeting is in September, after the August data comes in. And at that point, the data for last August, remember the one that was 0.5%, falls out and gets replaced by the new data. So if the August inflation read is also 0%, as what we're seeing right now for the last 2 months, then inflation overall will be sitting at just around 2.3% by the time they hold the meeting, just above the Fed's target. Is that enough data, Mr. Powell? Will that be enough to convince you? Now, I guess if that were to happen, there is probably no possibility that the Fed will not lower interest rates. I mean, I do understand that the FOMC average IQ seems to be roughly equivalent to a mentally challenged raccoon that's been lobotomized, but the data at that point will be overwhelming. The market thinks that at the September meeting, there is now an 83% chance of a 25 basis point drop and an 8% chance that the rate will drop 50 basis points. Now, the stock market is going to be ecstatic. I'm sure everything's going to blow up, go massively into the green when that happens, but the expectations are that the company debt will become cheaper to service, more money will go into stocks from treasuries, other places people are parking their money, people will start investing again, and consumer confidence will return because borrowing will be cheaper. Q4 could be pretty wild. But while everyone is busy popping champagne, it's really important to watch how quickly the Fed changes its stance and actually does their fucking job. Because if inflation plummets to 0% and the interest rate is still sat at, 4% or whatever, because the Fed only starts cutting rates in September and only wants to bring it down in 25 or 50 basis point increments every 6 weeks like they did on the way up, then you have a really big problem. Because if you don't spend your cash, you can get paid interest for keeping that cash in the bank because where interest rates are sitting. And at the same time as you are getting paid interest for keeping hold of your money, the value of things that you can buy is dropping. You can buy more with your dollar if you wait a bit. If the Fed continues doing nothing, wasting time, being the complete muppets with no clue like they are, this situation might go from being possible to being probable. And I can already see Jerome Powell and the rest of his cronies coming out to say, well, absolutely nobody could have seen it coming.